The Australian property market just experienced its biggest tax shake-up in 25 years. Treasurer Jim Chalmers' 2026 federal budget has officially targeted negative gearing and capital gains tax. But the new rules don't hit everyone equally. Whether you keep your tax breaks depends entirely on what you buy and when you sign the contract. Let's break down the math for 3 different types of investors using dead simple examples. First up, negative gearing. From the 1st of July 2027, the system splits into 3 clear pathways. To keep the math perfectly transparent, let's assume you earn a standard base salary of $160,000 from your day job, but your investment property incurs a net loss of $10,000 this financial year. Let's trace how your tax statement responds depending on when and what property you acquired. If you already owned your investment property, or executed the contract before 7:30 p.m. on budget night, you are fully grandfathered. You keep your upfront deductions against your salary. The same goes if you buy a brand new house or apartment. The government wants more supply, so new builds remain completely exempt. But here is the hammer. If you buy an established, existing home post-budget, you lose the ability to offset that loss against your wage. Your taxable income stays pinned at the full $160,000, while your $10,000 property loss is quarantined away in a property bucket. Part 2. Capital Gains Tax. The long-standing flat 50% discount vanishes entirely starting the 1st of July 2027. Instead, the ATO is transitioning to an inflation-adjusted system called indexation. You will only pay tax on profits that outpace the consumer price index. However, they've introduced a strict 30% minimum tax floor on net capital gains, preventing high earners from waiting until retirement to liquidate assets at lower tax rates. Let's map out a standard example. You make a clean $100,000 profit when selling your asset down the road. Under the old rules, half was tax-free, meaning you only paid tax on $50,000. For someone on a mid to high bracket, that equaled roughly $15,000 in tax. Under the new framework, the ATO adjusts your cost base for inflation. Let's assume that cuts your taxable gain to $90,000. But because of that hard 30% minimum tax rate, your bill hits $27,000. That's a $12,000 premium increase for the exact same market growth. Here is the master summary cheat sheet right on your screen. Take a screenshot now so you have it saved. The clear winners are post-budget new build buyers, who get to choose between the old discount or the new system upon disposal. Meanwhile, loading up on old established houses to clear your salary tax debt has officially hit a legislative wall. Remember, these changes need to pass through Parliament before becoming official law, so touch base with a registered accountant before modifying your strategy. What are your thoughts? Drop a comment below, hit subscribe, and I'll catch you next video.